now to speak about the issues that come up as a result of low interest rates, and it's going to be low for long and so on, and tell us what that means for financial stability, where of course that's one of the expert questions that you are associated with at the Bank of Canada. So looking forward very much to what you have to say, Carolyn. Thank you for being here.
Thank you very much. Well, there is quite a lot of illustrious history, so I guess the first thing I should do is thank you for inviting me here. The Official Monetary and Financial Institutions Forum, at least for policymakers like me, their analysis and commentary are invaluable. And as was alluded to, central bankers and other policymakers around the world have dedicated the last 8 years to rebooting their economies and repairing their financial systems. And we've faced, on top of all that, the added challenges of a number of sovereign debt crises, an oil price shock, pretty important for Canada, and most recently, the fallout from the vote that we've been calling Brexit. And so it's understandable that we've devoted a lot of energy to avoiding another financial meltdown and also to keeping the recovery on track. Now, it's perhaps not been as epic a journey as Homer's classic, but I think this odyssey has certainly proven long and perilous. And 8 years into this journey, there's an urgent need for all of us to consult the map and see where we're headed over the longer run. And it's time to take strategic decisions to help us avoid unnecessary trouble ahead. We all know that cyclical factors aside, demographic trends and other structural factors are acting as a drag on the global economy, and it's just the global economy's potential to grow. And it surely worries all of you, because growth is what ultimately drives the returns on your investments, and it may even determine your job prospects. And with economies that are expanding more slowly, having growth that's inclusive is more important than ever. Slow growth worries me as a central banker, not only because it reduces our room to maneuver to achieve our inflation target, it also worries me because slower potential growth materially increases the risk to financial stability. To explain these concerns, I'm going to start with a view of the long-term prospects for economic growth and real interest rates. I'll then give you some examples of how these prospects could translate into increased financial system vulnerabilities. I don't think, and I don't believe, that we're powerless though. And so I'll end by outlining some promising strategies that could lead us safely to a sustainable and solid growth path. Now, economic growth around the world since the crisis has repeatedly surprised economists on the downside. And it's led to the term, at least in Canada, that we've called serial disappointment. Now, the Bank of Canada's own forecasts have overestimated global growth by an average of 0.5 percentage point each year in the past 4. And private sector consensus forecasts were off by even more. Well, the slow and halting recovery is partly the result of a number of cyclical factors that are taking just years to sort out, including deleveraging in the private and public sectors. It's also the result of deeper structural trends that are driving down the economy's potential to grow. We estimate that the potential GDP growth at the global level has declined from a peak of about 5% in 2005 to just over 3% this year. This is huge. A 2 percentage point reduction in global potential growth translates into about $1.5 trillion in foregone output around the world in 2016 alone. If that pace is maintained, foregone output will total just under $9 trillion 5 years from now. And the slowdown has been widespread, although potential growth varies widely across countries. Don't need to tell you that if you're investing. We've got China's potential growth, which is estimated to be around 6.5%, and that's down from over 10% a while ago. And in advanced economies, it's much lower. Just as an example, it's about 1.5% in Canada and just perhaps a touch higher in the United States. So let's just remember that potential output is made up of two parts. The first part is labor supply, and the other part is labor productivity. Both of these parts are contributing to the slowdown in global potential growth. Now, labor force trends will continue, and the numbers are striking. The rate of growth in the working age population will be cut nearly in half at the global level over the next 2 decades. And it's difficult to quantify the impact of demographic factors in terms of growth because there are other offsetting factors. And what I mean by that is that a tighter labor market should, over time, drive wages up. And higher wages might actually persuade some workers to work longer or others to join the labor force. But these offsets are unlikely to reverse the tide. So far in Canada, what we see is that demographic effects have only been partly mitigated by increased participation rates of older workers. Now, the wild card here is really the second component of potential output, labor productivity. Unlike growth of the workforce, which is mostly driven by demographic trends, and these trends are predictable and evolve very slowly, productivity growth could change more quickly. And big technological advances that fuel sea changes in productivity, like electricity and the semiconductor, they're pretty hard to predict. So far this century, productivity growth has been hardly encouraging. The effects of the information technology revolution on productivity growth are fading, and the adoption of new technologies is actually slowing. And there's an additional source of drag that has come more recently, and it's from a significant slowdown in business investment, which is related to lingering uncertainty from the crisis and a steep decline in global trade. Without a meaningful rebound in productivity aging will lead to even lower potential growth than in past decades. Now, natural byproducts of slower potential growth are not only weaker corporate profits and dividends than we would have had otherwise, but also a lower average return on investments. And one way to gauge the effect is to estimate what we call the neutral rate of interest. And here what I'm referring to is the risk-free real interest rate that would prevail over the medium term if the global economy were operating at its potential. So this neutral rate would be just right to balance the full employment level of savings and investment. And in a lower growth environment, businesses just invest less and therefore have lower financing needs. And that drives down the neutral rate, since a lower level of interest is required to equate savings with investment. And this is one of the key reasons why we've reduced our estimate of the neutral rate for Canada over the past couple of years. We estimated that it was about 3% in the early 2000s, and it's about 1.25% today. Well, that's a big downward adjustment. Now, estimates of the neutral rate are highly uncertain, so it's best to put a range of plus or minus 50 basis points around these numbers. I don't want to leave you with the impression that a reduction in global potential growth is the only determinant of the neutral rate. It's not. There are also increases in global savings that we've witnessed over the past decade and a half, and the lingering effects of the financial crisis on an investment demand, and also post-crisis reforms. And while we often talk about a global neutral rate, it may be different in each country. And that's because an array of factors, like country-specific risk premiums, push the interest rates to different levels across countries. We like to keep an eye on the neutral rate because the stance of monetary policy can be measured by the difference between the level of the policy rate and the neutral rate. Some economists, like Larry Summers, I'm sure you've read about this, think that there's a risk that the neutral rate is so low in some economies that the effective lower bound on interest rates is preventing central banks from providing sufficient monetary stimulus. What they argue is that the structural factors that are responsible for the low neutral rate could persist well into the future, contributing to secular stagnation. In Canada, with our target interest rate at 0.5%, we judge that monetary policy is quite stimulative, although less so than it would have been a decade ago when the neutral rate was higher. At the same time, as population aging continues, the neutral rate could fall further unless productivity growth picks up or global savings fall. And the longer that weak investment persists, the more important this risk becomes. And while we typically link financial stability risks to unsustainably high growth, slower growth and lower returns can also add to vulnerabilities in the financial system through a number of channels, and I'm going to talk about three. The first is what I call a macroeconomic channel that works through households. Years of low interest rates have, by design, encouraged growth in household credit and left many households highly indebted. In Canada, average household debt is around 165% of disposable income. As household income growth slows, we can expect that shocks like changes in commodity prices that hurt an economy's terms of trade will result in more frequent and longer periods of shrinking incomes. This is related to two related factors. The first is just simple arithmetic. The lower the average growth rate of household income, the more likely it is that an adverse shock is going to push it into negative growth territory. The second factor is a bit more subtle. A lower neutral rate also makes it more likely that interest rates will be constrained by the effective lower bound. And this means that monetary policy will have less scope to support income growth during periods of economic weakness. To get a better sense of the practical importance of these factors, we ran some simulations with the Bank of Canada's main policy model. And what we found is that for Canada, the lower neutral rate means that the probability of being at the effective lower bound has gone up from around 1.5% to about 7%. And that's if you assume that the effective lower bound is minus 0.5% and that we get hit with the same kinds of shocks that we've seen since 1995. So our simulations also confirm that there would be more episodes when the income of the working age individuals actually declines, and the median duration of those episodes would lengthen from 3 to 6 months, or perhaps more, if low-income households were to bear the brunt of the growth slowdown. Now, these are just results from a single model, and so you have to take them for what it's worth. But what it says to me is that households would be more vulnerable, particularly if they were already highly indebted. This is because the debt burdens of households relative to their incomes would rise more frequently than in the past. And this would typically happen when growth is weak and business and financial institutions are relatively more vulnerable. Of course, how worried we should be about indebtedness is related not only to income, but also to the debtor or the value of the debtor's assets. And when it comes to households, the most important asset in many jurisdictions is residential property. In Canada, housing equity represents about 1/3 of total household assets. And while demographic forces, the baby boom, have been a source of upward pressure on house prices in the past, continued population aging and slower population growth suggest a reversal of this trend. All else being equal, demographics will weigh on the demand for housing. Any price effect would directly impact the net wealth of households, at least in the transition period. Obtaining reliable estimates of the impact of demographics on house prices is very difficult. Much is going to depend on the response of housing supply and the extent to which older households downsize. Other factors are going to influence housing as well, many of which could work in the opposite direction. Just for example, urbanization and immigration could bolster demand in some markets. But the relative importance of these factors will differ within and across jurisdictions around the world. Nonetheless, there's just no guarantee that relying on housing wealth will yield the expected payoff in all cases. The second channel through which slower growth and lower returns affect financial stability is related to risk-taking. Clearly, as households cope with shifts in the valuation of their main asset, they may also face lower returns on their investments because of the lower neutral interest rate. And since people are living longer, which is fundamentally a good thing, they may need more savings for their retirement years. Now, predicting the price impact again for lower interest rates on household savings is not straightforward because not all households are going to choose the same strategy. Empirical studies that look at this find that savings will typically decline when interest rates fall. And this suggests that on average, workers, instead of saving more, generally choose to invest in riskier assets or work longer or earn lower retirement incomes. But these aren't normal times, and with interest rates low for so long, there may be a point at which we observe higher savings. Asset and pension fund managers also face increased incentives to take on more risk with a lower neutral rate, and defined benefit pension plans are in a particularly difficult situation. Their funding and benefit levels were set based on shorter lifespans, on smaller number of retirees relative to the working age population, and also higher discount rates and higher returns. It's not surprising that the funding status of major defined benefit pension plans and other plans has generally deteriorated. And although plans could turn to increased contributions or lower benefits over time, many pension funds are also adopting strategies that include a larger share of alternative assets to generate higher returns. Some pension funds are also taking on more leverage. Large defined benefit plans have the scale and the expertise to diversify into less liquid assets and into regions with higher expected returns, like emerging markets that have a higher potential to grow. So it's not fundamentally a bad thing. They also have a greater ability than most investors to weather short-term market volatility and even take advantage of it, take the other side. There's some studies that show that they can provide a counter-cyclical force. And that's because their liabilities are largely long-term and their funding is secure. Nonetheless, there's always a however with a central banker. Pension funds are large participants, at least often they are. They certainly are in Canada. And so the risks in this sector really merit some careful monitoring. Individual investors also face similar challenges. As the rates of return available from public bond and equity markets decline, they too are searching for alternative sources of yield. And the investment industry has responded by creating new products that expand the range available to individual investors, but these new products also carry risks. Alternative open-ended mutual funds are an interesting example. They appear to offer daily liquidity for underlying assets that can be very illiquid. And one example is commercial real estate or commercial bank loans. In reality, this practice could result in redemptions being suspended, and we saw a bit of this with some UK property funds in the wake of Brexit. It may be a good thing that market participants are investing in a wider universe of riskier assets if it increases access to funding for productive projects. The crucial question here is whether investors can properly price and manage the risks. Now, history is rife with examples of when excessive and prolonged search for yield ended pretty badly. So the third channel relates to bank business models. In most economies, the banking system is integral to the provision of credits to households and businesses, and so to the efficient transmission of monetary policy. However, banks can be the source of financial instability, and so they need to have, among many other things, a viable business model. Now, in principle, a key determinant of a bank's level of profitability is net interest margins. And at first glance, there's no theoretical reason banks couldn't achieve their desired margins even if the neutral rate is lower. In practice, however, some problems seem to arise when policy rates drop to very low levels. And this is because banks don't always have the flexibility to reduce their funding costs in line with declines in their interest income. In particular, banks have proven reluctant to pass on lower interest rates, especially negative rates, onto their retail deposit base. In the United States, if you look at the data, you can see net interest margins narrowed by about 20% between 2010 and 2015. And without adjustment to expectations for return on equity, these pressures on margins could prompt banks to change their business models and shift away from deposit-based lending towards other activities. That said, banks are limited by Basel rules in the amount of additional risks that they can take on. Pressures on bank business models come at a time when banks are also facing increased competition for profitable segments of the value chain, like retail payments and data. Clearly, banks are adapting in response to these pressures. At the same time, important financial activities like, well, I can give you a ton of examples, with all those related risks, are migrating to the less regulated sector. And while financial reform has reduced the likelihood of instability coming from banks, the trends bear monitoring. So these sources of risk to financial stability may be at times reminiscent of Odysseus's voyage back to Ithaca. Unlike Odysseus, though, we're not at the mercy of the gods. And there are some promising strategies to mitigate the risks ahead. The first is to promote a sound global financial system. G20 countries must complete the post-crisis financial reforms that they've agreed to, whether those reforms are related to banks, financial market infrastructures, or non-bank financial intermediation. We saw some of the benefits of increased bank capital and liquidity in terms of market functioning in the aftermath of the Brexit vote. It's still early days, though, for financial reform, and we may not have gotten everything perfectly right. And so the FSB is appropriately focused on measuring the effects of the reform, including those on financial market functioning and cross-border financial market integration. Another important aspect that should be considered where it's possible is the impact of financial reforms on wealth and income distribution. A sound financial system also requires macroprudential tools to lean against credit cycles. We know that the effects of downturns in these cycles can be costly and very difficult to clean up. And monetary policy is just too blunt an instrument to fine-tune credit cycles. That's why macroprudential measures aimed at specific sectors, like the housing sector, are a better way to address financial vulnerabilities. Now, a second strategy is to adopt policies that support growth. You wouldn't be surprised to hear that as a central banker. I think that monetary policy best contributes to the overall health of the economy by keeping inflation low and predictable. In pursuit of this goal, monetary policy can at times ease the financial stability risks associated with negative shocks that reduce households' disposable income and their ability to service their debts. And this was the case in Canada when we lowered our policy rate twice in 2015 in response to the oil price shock. At the same time, the scope for monetary policy to offset negative demand shocks will be more limited as we face a lower neutral rate. At Jackson Hole last month, central bankers discussed at some length some of the other tools they have developed, like quantitative easing and productive uses of their balance sheets. Now, the efficacy and long-term effects of unconventional tools will only be known over time. But there's another reason why we should not count on monetary policy to solve everything. Monetary policy just isn't well suited to deal with structural problems, and I hope I've convinced you that today's challenges go far beyond temporary shocks. Fiscal policy can be a powerful tool to boost growth from both the demand and supply sides. Infrastructure spending can be particularly effective if it raises trend labor productivity, since it can help raise potential growth and ease pressures on the neutral rate. That said, government spending can't solve everything either, because we know that an aging population will put pressure on public finances through pensions and health care spending, among other things. When I was at the G20 meeting in Chengdu this summer, we reiterated the urgency of a comprehensive strategy to achieve a stronger trajectory for global growth. So in addition to investment in infrastructure, countries have agreed to raise potential growth by reforming their product and labor markets, as well as their tax systems, and to develop policies to support innovation and enhance trade. Now, the last strategy that I'll mention is crucial. We have to adapt to the new reality of lower potential growth. And this means changing our investment strategies and risk management practices to reflect lower rates of return for any given level of risk. For households, this may mean saving more before retirement or planning for a lower post-retirement income. It also means acknowledging a reduced capacity to grow out of existing debts. The faster we do this, the safer the financial system will be. So it's time for me to wrap up. At one point in their journey, Odysseus and his men came across an island that was inhabited by lotus eaters. Now, the fruit of the lotus makes those who eat it forget about their journey. So much so that Odysseus had to force a couple of his companions back on the ship to continue the trip home. It strikes me that we may be at a similar point. After what we've been through, it's tempting to enjoy some respite from our own long journey. We cannot. If there's one thing we've learned from the past decade, it's that imbalances can take a long time to accumulate and even longer to resolve. Investors and market participants have to adapt to lower neutral rates. Countries must work to meet their G20 commitments and take the fiscal and structural measures that will improve long-term growth. Authorities will have to continue to solidify the global financial system and guard against emerging problems. It's a long road, but it's the one that's going to get us safely home. Thank you.
Thank you, Carolyn. So that's given us some really good food for thought. So we'll have a few questions from the audience. Maybe if I could just kick off here. You seem to be saying that, unlike in the Odyssey, the story will not be driven by some vengeful god. The central banks, though, in many ways have been thought of as almost godlike creatures. You also said that one shouldn't rely too much on monetary policy. You only gave a bit of a nod to QE, and so the question is, do you think that QE itself, in many advanced countries, not all, is itself driving some distortions in the financial system that could indeed be abetting those controversial and difficult questions that you mentioned? And isn't it going to be a terrible dilemma for central banks to try to get out of this QE? Because that might imply interest rates would go up, which would then hit households, which would have all the deleterious consequence that you mentioned. So how do we get out of that particular conundrum, even if central banks are less than gods?
Well, I think that central banks did a fabulous job over the crisis to support demand and also just support market functioning, because it all wasn't about increasing the aggregate amount of liquidity out there. It was about improving market functioning by redistributing the liquidity across the participants. And so that being said, the point that I would like to make very strongly is that central banks cannot solve all problems. And so this idea, I guess if gods can, then central banks aren't like gods, are they? They're very good at targeting inflation and doing what's needed for that, but they're not the only game in town. And certainly for structural problems in particular, except for offsetting any lingering effects from hysteresis, really, that's a job of structural policies and fiscal policies. So, and we know that from our economics textbook, 101 practically. Now, your question about QE, Canada has been lucky enough to not have to, use that as a tool, although it is a tool in our toolkit. We've done some work trying to, and many others have, to see whether or not the QE that's been done so far has been effective. And what generally comes out, economists will find two sides to every coin for sure, but I think the balance of evidence is that it has had some effect on the yield curve. and that, one can imagine that those effects have translated into increasing demand. Of course, it's only going to be over time when we have enough data that you're going to really be able to figure that out. What you're talking about, though, aside from that, is the exit. And certainly the exit strategy to these policies is going to be very important. I know that the central banks that have engaged in these policies have thought very hard about it, and it's in everybody's best interest, including theirs, to do it in an elegant way. I think a lot of it depends on communications and also the timing. And so it remains to be seen, but I don't see it forcibly as being a disaster. In fact, I can see ways where the exit could be elegant.
Just to press you on that point before going on to the floor, Ben Bernanke has recently said that we've got to get used to central bank balance sheets in some of the major countries remaining at this very high level,
right,
historically high, for longer than people up to now seem to have been thinking. So he's almost saying, why are we talking so much about the exit? Do you agree with that thought?
Well, I think in part that's what I meant by the timing. Clearly, if you hold things to maturity, that central bank balance sheets are going to be larger for longer. Those are decisions that every central bank needs to take individually, because it's going to depend on a number of factors. But it's in my mind, there are ways to manage the exit where it doesn't forcibly result in big buildup in pressures at the long end.
Okay, thank you. Yes, who would like to ask a question then? And please, gentleman at the back there. And please, could you stand up and say who you are, because everybody can then hear you much better.
John Buss, Goldman Sachs Asset Management. So when you look at the various factors that are weighing on potential growth and neutral rates globally, what is your sense as to how these various factors are differentially impacting Canada, say, relative to the United States? Are there some ways in which demographics or capex or regulation are weighing more or less on Canada? Thank you.
Sure. So when we look at the determinants of the Canadian neutral interest rate, clearly we look at the determinants of the global interest rate, and in particular what's happening in the U.S. There's lots of work that shows, particularly at the long end, that there's a high degree of correlation between our long end and that of the U.S. I think for that reason, the neutral rate that we would come up with would be very close to the neutral rate in the U.S. The one factor that's slightly different is perhaps the rate of aging of the population. We're a little bit ahead of them in terms of demographics, and so that means that for a time our potential growth is a little bit slower.
But you're aging very gracefully, I'm sure.
Why, thank you.
There's a person over on that side. Yes, please.
David Milliken from Reuters. I think sort of last week the sort of Bank of Canada talked with sort of a little bit of concern about sort of the outlook for exports, and that sort of particularly exports in the sort of non-oil, non-commodity sector hadn't been growing as fast as you had hoped. I was just wondering if you could sort of say any more about sort of where your concerns lie with that, and whether you still think that it's sort of most likely that the Canadian Bank of Canada's sort of next rate move will be to raise rates, or whether you think that now there is a conceivable chance of a rate cut.
So we did have an interest rate announcement last week where we kept the overnight rate unchanged. What is being referred to is the fact that we talked about disappointing exports. And of course, we've had a big commodity price shock, which means that those industries that are dependent on oil and energy and other commodity prices are in decline. Exports in other areas have actually been picking up. For the second quarter, what we ended up with was disappointingly weak exports that could, in large part, but not entirely, be explained by surprising weakness in the United States, particularly in business investment, which of course is a big component of demand for Canadian exports. And so we're right in the process of doing our update to our projection from July. It'll be out on October 19th. There are just a number of factors that we need to look at. Clearly, for exports, we need to understand whether there's something else going on besides a temporary weakness in business investment in the U.S. We also look need to look at other factors that are supporting demand. For example, fiscal policy is going to be increasingly stimulative in Canada. There were measures that were announced in the budget last spring that are just coming online right now, a child tax credit, but also significant infrastructure investment. And so we need to just look at those very carefully.
Do you want to be drawn on this idea about whether the next move will be up or down? Or are you waiting for the Americans? What do you think they're going to be up to next?
Well, they're going to be up to exactly the right thing. But I could just say it's interesting. People always ask that question, and we're inflation targeters, so we do what we need to do to meet our inflation target. And sometimes that happens to be correlated with the U.S. economy, and sometimes it doesn't. And so it really doesn't have an effect on what we would do, other than it does change the financial conditions globally, and we take that into account. Now, I have to say that we do see a pickup in the U.S. They look like things are aligned for a smart pickup in the U.S. for the rest of the year, and then solid growth after that. And so, in our minds, if the Fed finds it a right time to make a policy move, then it's going to be because they see some solid strength in the U.S. economy as well, and that's a good thing for Canada.
Thank you. Who would like to go next? Yes, please, Sir Gerard.
Gerard, I'm a retired banker.
There's a microphone as well for you, Gerard. Why don't you stand up and everybody can see you in your full flowering?
Well, Larry Summers was present at the back of your conversation, and the G20 also. So secular stagnation could, in the opinion of many, represent a phase where the world digests all these wonderful things we've invented, the IT, and we may look forward to faster growth when we have completed the digestion of these innovations. But if between the lag and the fact that our demographics have weakened are going to condition our growth or our slow growth over the coming years, then shouldn't we focus on a part of the world you haven't spoken of, the one that grows certainly, which in terms of demography shows the way, assuming it's the right way, namely Africa. I mean, you can't blame the Africans for not producing babies. They are good at it. And they used to be in great fashion up to a couple of years ago. Everybody was interested in Africans, and all of a sudden, Africa has... So could they, during this secular stagnation, which will last 5, 10 or 20 years, I don't know, could Africa and the other non-G20 countries represent the white man's hope?
Well, there we are. Say a few words about Africa then, Carolyn.
Well, it's interesting, this dichotomy between the level of potential growth in advanced economies and the level in emerging economies. So emerging economies as a whole have started from a very high level, and their growth is also slowing, but it's going to end up, like China, at a much higher rate than advanced economies. So overall, emerging economies face the same demographic trends as the advanced economies. Now, you're right, though, that Africa is a bit of an outlier. I think one of the discussions at the G20 is really about is focusing on inclusive growth. And inclusive can be looked at from two perspectives. One, it's inclusive within any given jurisdiction, within any country, but also it could be interpreted as inclusive from a global perspective, which includes those countries. And so there's a lot of effort, either through the FSB or others, to include different regions, including Africa, in discussions about the kinds of reforms that will support financial stability, which I think it just underpins a well-functioning economy. So there's the pillars: the good government, the solid public finances, solid financial system. And those things are really the platform or the foundation on which those countries can build. And there are efforts to draw them in.
I think what Gerard really wants to know, Carolyn, is whether you're putting some of your Canadian pension fund money into some sort of emerging market Africa fund. That's what he really wants to know.
Well, you'll have to ask the pension funds about where they're going. They certainly do have a global mandate, and they're using it.
But just imagine that the Congo or Nigeria get their act together. Look at their fantastic wealth and look what they produce out of it.
I think we get the picture, Gerard, yes. Yeah.
There's huge potential.
Who would like to have the... Yes, please, lady over there. Thank you very much.
Hi there. You mentioned trade, and of course, Canada's relationship with the U.S. and obviously they have NAFTA, and they have a historically very strong trading relationship. But of course, very much on our minds here in the UK and in Europe is Brexit, and one of those is the status of the various trade agreements, CETA being a very important one. And I guess, but if Canada's going to look more outward and look for more trade agreements, that has to be accompanied by a way of dealing with cross-border regulation of financial services. So I don't know if you have any further thoughts on that, because if you're going to have more trade, you need to have better, more harmonized. You can't afford to have a fragmentation
Right.
in financial markets.
For sure. Canada's a small open economy. We benefit a lot from trade. And of course, there are downsides to that as well, the structural adjustments that are required. And when you get a shock, for example, like we had from the oil price. And there has been a push from the government, this is outside the Bank of Canada's responsibility, but to just broaden the range of agreements that we have with different countries, and also the range of products and services that we export in. And that's a pretty important part of our strategy. Clearly the current circumstances mean that there are delays, and I don't know if that's any different from any other time. These things are difficult to negotiate. What is very clear, though, is that for any financial transactions to take place, it's global. And so you do need an integrated financial system that has, as much as possible, compatible, if not exact, financial regulations. And that's been a bit of an effort, and not always successful, but a real effort on the part of the Basel Committee, the Committee for Financial Market Infrastructure, and the G20 to work on global standards, and then work to see that these standards are applied in a consistent way. And part of that is through peer reviews. And so I don't know if you've seen them, but the FSB does peer reviews, so does the Basel Committee. And what that is, you go into a country and you say, did you apply in a consistent way, at least in spirit, what we agreed to around the table? And I think those are very important commitment devices, because then people know that it'll be clear when they don't. Now, there are in some areas, some frictions, and I would say that more work needs to be done. And in fact, there's an emerging area where work needs to be done, and that's with respect to the emergence of financial technologies, because a lot of these transactions depend on their payments, right? And so as new payment systems emerge, it's going to be really important that there's protocols and harmonization of the rules and regulations across countries.
You mentioned the Brexit and the British referendum several times in your speech as being a shock. In terms of your conversations here, walking around, talking to people, kicking the tires here and there, do you find people more or less upbeat or more or less gloomy than you had actually expected, having been watching this from afar?
I think you would have a much better view to that, given all the things that you've written and the OMIFF have written. I think it's just early days. To be fair, I just think it's early days. Clearly the tone around the G20 table was, wow, it was good to see how well markets functioned given the size of the surprise, in a sense. Like, everybody knew the day, of the surprise, so maybe that made it a little bit easier. Surprises often, you don't even know the day. But at the same time, there was some volatility, but positions got moved and transferred in a way that was relatively orderly. And I think the lesson that we took from that, whether it's right or wrong, is that there were some benefits from some of the financial reforms and the increased capital and liquidity that had happened. And there were some benefits to the work that had been done here to do the stress tests on the banks, and that stress tests that looked somewhat like Brexit but wasn't Brexit, and so that the banks were actually prepared. And so I would take that as a lesson. But that being said, where it all settles out really depends on how elegant the negotiations go, where the country ends up in terms of the relationship. And it's just too early to say. Certainly, we've marked down our forecast a little bit because of it, but not a lot, because we're assuming it's going to go well.
No, thank you. Let's have another question there from the lady there with the laptop.
Hi, Jill Ward from Bloomberg News. I was just wondering, you mentioned fiscal stimulus. Do you think that what's being offered right now in Canada is enough to jumpstart the economic recovery? And also, just some color on what the Bank of Canada meant last week when it said that inflation risks have tilted down. Inflation's been below target for almost 2 years already, so why flag that now? Thank you.
Sure. So with respect to fiscal stimulus, it's up to the government actually to decide whether or not it's enough. They have their full set of objectives, and they have announced some very significant measures that...
Don't you raise your eyebrows if they do too much, then?
Not in a room like this. I think that the government has quite an ambitious growth plan that the Minister of Finance discussed earlier this week, in fact. And what we do is we take fiscal policy as given and we put that into our outlook and determine whether or not more needs to be done from the monetary policy side. What we meant last week with respect to risks of the inflation outlook being tilted to the downside are related to where we see the risks relative to the inflation profile that we had projected in July. So normally when we do a projection, we of course make every attempt to balance the risk. So it would be very unusual if risks weren't balanced when our forecast was fresh. But over time you get an accumulation of data that leads you to think that, well, maybe there is a little bit of a tilt. They're not quite as balanced as they were before. And that's what we meant by it. And the source of that tilt, as I said earlier, is really coming from the question marks we have about exports, which we're digging into right now. And we'll have an update to our projection October 19th.
Is there another question from the audience, maybe? Yes, please, sir.
Thank you. Jason Douglas from the Wall Street Journal. I think I'm right in saying that you review your inflation target every 5 years, and you might be doing so this year.
Yes.
Given the problems you were describing with the zero lower bound and so on, you will know there's a fairly lively academic argument about central banks ought to raise their inflation targets. What would be the pros and cons of doing that in Canada? Thank you.
Sure. So you're absolutely right. We are renewing it this year. In fact, we renew our inflation target agreement with the government on a 5-year cycle, which is great because what that does is we agree on our objectives, and then we have the operational independence as a central bank to achieve those objectives. Now, the questions that we determined a couple of years ago, because we always take a while to do our research, were in fact, what should the optimal level of the target be? Should it be 2, as it is now? Should it be 3? The last time we reviewed it, we actually looked at lowering the target, and we decided that wasn't, given the zero lower bound or the effective lower bound, that wasn't a relevant question. Really, the relevant question was, should it be higher? And we also looked at the role of financial stability in monetary policy. So should monetary policy lean? What are the range of tools that can be brought to bear, and what is the role of monetary policy in that? And then one was more technical. What's the right measure of core inflation, which is what we look at as a guide because total inflation is quite volatile. So with respect to the 3%, there's a paper which you can look at on our website. We have a whole page dedicated to the research that we've done on all the questions for inflation targeting. And there's one in particular that does look at the pros and cons of raising the target. Certainly it's a balance. We haven't finished our discussions internally or with the Minister of Finance and on where we stand at the end. But I could say that one of the advantages of raising the target is the one that you said. The probability of hitting the effective lower bound is just smaller. You can also imagine that with a higher target, to the extent there's downward rigidity in nominal wages, people don't like nominal wage cuts. They're fine with real wage cuts, but nominal cuts just seem to be a bridge too far. Well, that helps put some grease in the wheels to make an economy run smoother. Those are kind of two top drawer potential advantages to raising the target. Now, of course, on the flip side, you have all the disadvantages of higher inflation. I mean, you have a transfer of wealth from the private sector to the government, and with an aging population, you also have more people living on fixed incomes that would be faced with higher inflation. And so there are other potential disadvantages. The higher inflation goes, the more volatile it is, which just adds to risk premiums. So these pros and cons need to be weighed. And they also need to be weighed in the context of, well, what else can we do? Because if the real problem is structural, in a sense, then shouldn't energy be concentrated on dealing with those structural questions before imposing all those extra costs with respect to inflation? So there are pros and there are cons. The bar's pretty high to change something for Canada, and we should be in a position to have something for everybody by the end of the year.
Good. Well, it's a very interesting question. I think I'm right in saying that the UK and Canada are probably the two countries in the group of 7 that are closest to meeting the 2% target. So we could set a rule that the two countries with Canadian governors should be first out of the trap in coming up with a new inflation target. Well, I'm not going to ask you to comment on that, but is there a final question maybe from the audience? If not, I'll put the final question, because you mentioned infrastructure several times, also as being a source of growth, but also something where people are necessarily putting some assets, including your very large pension funds who are buying up infrastructure as though there was no tomorrow in some cases. And I know some of them have been a bit worried about how their managers are going out and buying nondescript buildings at huge prices. You said we mustn't forget the lessons of the past. Are you worried that there might be a bubble building up in infrastructure, not so much in Canada, but worldwide?
Well, I'm not going to comment on the investment strategies of our pension funds. I think they're the best ones to do that. They've got a view on their own risk and reward appetite, and also on the value of the projects, the specific projects that they're in. I mean, clearly, I'm the chair of the pension committee for the Bank of Canada's own pension, and so I understand when the long rate declines or discount rate declines, I see what happens, and I see what's happening in terms of the range of assets that you could invest in. Now, what really matters for infrastructure is what you said, how crowded the space is, but also your ability as an institution to manage that kind of risk, because it's not like holding a portfolio and then it's done. You really have to go and you have a different set of management skills, especially if the infrastructure isn't already there. If it's greenfield, that's a completely different animal. And so different pension funds in Canada and elsewhere have decided their own strategy about where they're going to invest. One always worries about crowded spaces. And I think the thing, if it's a defined benefit pension plan, one needs to just think about the fact that their funding is longer term, their funding is more secure, their liabilities are longer term, and so they're better positioned to weather some downturns, but nothing's impervious, that's for sure.
Good. Well, thank you.